Hey everyone. As you've probably already heard, the Federal Reserve raised the overnight rate by another 25 basis points last week, taking the federal funds rate to the 5% to 5.25% range. That's in alignment with the Fed's guidance following their March meeting when they said the target was in the 5.1% range. And although the Fed hasn't given a clear signal that they're committed to pausing their rate hikes, Chairman Powell did say they plan to closely monitor data ahead of their next rate decision in June. One of the more important forces in play is the banking sector. At the beginning of last week, First Republic Bank was seized by federal regulators, then sold to JP Morgan Chase Bank at auction. Leading up to its shutdown, First Republic had over $100 billion of withdrawals in the first quarter, which basically bled out their balance sheet. That's similar to what happened to Silicon Valley Bank, but First Republic's buyout by Chase will have a more significant impact on real estate borrowers. According to the First Republic's 8K filing at the end of last year, about 82% of their lending was on real estate. But that doesn't make their portfolio inherently risky. The vast majority of their lending, 61%, was for single-family residences. And about a third of their real estate lending was in the Bay Area, with additional concentrations in Los Angeles, New York, and Boston, where their bank branches are predominantly located. While these metros were particularly hard hit by the pandemic and have generally been slower to recover than many other cities across the country, single-family homes in these markets have historically increased in value more aggressively than most other metros. Considering that average home prices have increased by 34.4% over the last 3 years, it's unlikely that First Republic's single-family portfolio has greater debt than the loans placed on the properties. The houses probably aren't facing foreclosure risk. So it doesn't look like First Republic had a significant structural lending portfolio risk, but the run on the bank did drive them over the edge. This could be an ongoing problem for any banks that have a concentration of large depositors, especially if the bank offers very low interest rates on bank deposits. The 3-month Treasury has been north of 5% for about a month. In comparison, First Republic only offers about 1.5% interest on savings accounts. As long as savings accounts and even CDs pay significantly lower yields than other options, banks will remain at risk of losing deposits. And short-term interest rates like the 3-month Treasury tend to be pretty closely aligned with the Federal Reserve's overnight rate. Which brings me back to the Federal Reserve's decision to raise the overnight rate by 25 basis points last week. While Chairman Powell remains very noncommittal about taking a pause in the rate increases going forward, if they continue to push rates, they will place more local and regional banks and perhaps even some of the bigger banks at risk. This risk factor is not lost on the Fed, which leads me to believe that a pause may be coming unless a major inflation surge appears in the next 35 days. The vast majority of the inflation readings have been trending lower for the last several months. The most optimistic reading, in my opinion, is the Producer Price Index, or the PPI. That rate is down to 2.8%. To put that in perspective, the Producer Price Index peaked at 11.6% last year in March. The PPI is important because it measures inflation on manufacturing inputs, which are upstream drivers of inflationary pressure. As PPI inflation abates, that should help alleviate pressure on broader inflation indices like the Consumer Price Index and the Personal Consumption Expenditures Index favored by the Federal Reserve. Hopefully, these trends will continue over the next month, allowing the Fed to take a break. If that comes together, it should help stabilize the banking sector and allow lenders to begin normalizing their lending practices. It will take time, but eventually more stable Fed policies will enable banks to reduce their safety spreads and begin to lower their rates. And that in turn will enable commercial real estate investors to stabilize their underwriting on assets. That's what it boils down to at this point. If the Federal Reserve takes the pressure off, the commercial real estate market can begin its recovery process. Structurally, most types of commercial real estate still offer a promising outlook. Long-term structural demand drivers like demographics, job creation, and consumer spending remain sound. That suggests that once we get past the short-term economic and financial market turbulence, the long-term drivers will re-engage, supporting space demand for most property types. And it's those underlying demand drivers that are most essential to long-term investments like commercial real estate, which reiterates why investors need to keep their eyes on the horizon.